Hello, I hope you are ready for today's lesson because we are going to cover a very important yet often overlooked metric called free cash flow, or FCF. We have covered net income in previous lessons, and we learned that income is not the same as cash. The difference? Well, you cannot spend net income directly. You can only spend cash. Second, it is much harder to manipulate cash than it is to manipulate reported earnings. Therefore, cash flows are often a more accurate measure of profitability. Third, while earnings represent current profitability, free cash flow signals future growth prospects. Finally, free cash flow is an input for one of the most commonly used intrinsic value models, the discounted cash flow model, which is explained in the How to Value Stocks ebook, which is part of Lesson 8. So let's find out what this mysterious free cash flow is all about. First of all, what is it? Well, we could define free cash flow as the amount of cash a company has left after it has paid for all its expenses and investments. In other words, a company receives some cash throughout the period, but it also has to pay some cash to keep the business running. For example, they have to pay their rent, their electricity bill, the maintenance of their machines, the pizza delivery guy, etc. This all costs money. The money that the company has left after paying for all this is called free cash flow. So what's free about these cash flows? Well, they already paid for everything to keep their business running, so now they are free to spend the cash that they have left on repaying debts, paying dividends to shareholders, buying back shares, or to facilitate the growth of its business. Free cash flow is sometimes called owner earnings, because in theory, it is the cash that can be taken out of the business and given to the owners of the company, its shareholders, while the company could continue running since they already paid for their operating expenses. So where can you find this magical free cash flow figure? The thing is that companies are not required to report free cash flow on their financial statements, so you'll have to calculate it yourself. Fortunately, this is pretty easy. All you need are two inputs from the cash flow statement. The first one is cash from operations, sometimes called cash from operating activities or operating cash flow, which is the cash a company generates from its normal business operations. The second is capital expenditures, which is sometimes called CapEx or investments in property, plant and equipment on the cash flow statement. Capital expenditures include maintenance costs as well as investments in growth. Again, the jargon is a bit confusing, but don't worry, because these terms are explained in more detail in the glossary document, which is part of this module. If you take cash from operating activities and subtract capital expenditures, what you are left with is free cash flow. To make things a bit easier for yourself, GuruFocus.com has already calculated the free cash flow for you and lists it on the bottom of its cash flow statements. Now you know how to calculate the free cash flow of a company. But this absolute value does not tell you the whole story. You must ask yourself some questions, like where is this cash coming from in the first place? For example, it is much better if a company is able to generate this cash by itself from its earnings, rather than by relying on debt to remain liquid. Another important question to ask is what the company is spending its cash on, because if two companies have identical free cash flows, this does not necessarily mean they will grow their future cash flows at the same rate. Let's look at the following example. Company A has the same free cash flow as Company B. The difference is that Company B is spending twice as much on capital expenditures. This means Company B is investing more money into future growth than Company A. On the other hand, it could also mean that Company B is simply paying higher maintenance costs for its factories and machinery. Some industries simply require more capital expenditures than others. You'll have to read a company's quarterly or annual reports to find out more about this. A company could also be spending its money on repaying debt, buying back shares or paying dividends to its shareholders, which are all important things from an investor's point of view. So a low free cash flow does not necessarily mean a company is not doing well. It all depends on what it is spending its cash on. However, if a company consistently reports negative cash flows while reporting increased earnings, this is a big warning sign, because this is unsustainable in the long run and could indicate earnings manipulation. We'll cover this in more detail in the upcoming lesson. Negative free cash flow might also indicate that a company does not have the liquidity to stay in business. The only two outcomes in such a case are either bankruptcy or taking on more debt to finance the company. These are both situations you want to avoid as a value investor. Falling free cash flows are a warning sign as well, because it could indicate that a company is experiencing a slowdown in business, which means future earnings may not be able to grow. Remember, earnings represent current profitability, but free cash flow signals future growth prospects. Since we were talking about ratios in the previous lesson, let me give you an alternative to the commonly used price-earnings ratio. You guessed it, it's the price to free cash flow ratio. Simply divide the market capitalization of a stock by its free cash flow. Market capitalization is simply the current share price times the number of shares outstanding. You now have an indication of how much investors are willing to pay for each dollar of cash a company generates. In general, the lower the price to free cash flow ratio, the better. If you flip this formula so that you divide free cash flow by market capitalization, you get another ratio, called the free cash flow yield. This gives you an idea of how much cash a company is generating per dollar of market capitalization. Higher is better in this case. Of course, both of these ratios are similar, since they use the exact same inputs. And just as with the PE ratio, I suggest you do not rely on these ratios too much. Even though cash might give you a more accurate picture than earnings, these ratios still do not tell you whether a stock is undervalued with respect to its intrinsic value, and these ratios differ greatly per industry. Besides free cash flow, it is also interesting to look at a company's cash reserves over time, which are reported on the balance sheet as cash and cash equivalents. Is a company growing its cash reserves over time, or is it burning through its cash? Again, even if a company's cash reserves are decreasing, this could simply mean they are investing this money into future growth of the business. So always put these figures into perspective by asking yourself what the company is spending its cash on. To summarize, free cash flow is the amount of cash a company has left after it has paid for all of its expenses and investments required to keep the business running. Free cash flow can be used for repaying debts, paying dividends to shareholders, buying back shares, or to facilitate the growth of its business. Free cash flow is not reported in the financial statements. You have to calculate it yourself by taking cash from operating activities and then subtracting capital expenditures. The absolute value of free cash flow does not tell you the whole story. You have to dig a bit deeper. Ask where the cash is coming from. Is a company generating these cash flows from their own earnings, or do they rely on debt? Ask what the company is spending its cash on. Are they investing in future growth, paying dividends, buying back shares, paying off debt, or are they simply spending it on maintenance costs? If a company consistently reports negative cash flows while reporting increased earnings, this is a big warning sign, because this is unsustainable in the long run and could indicate earnings manipulation. Negative free cash flow might also indicate that a company does not have the liquidity to stay in business, at least not without taking on additional debt. Falling free cash flows are a warning sign as well, because this could indicate that a company is experiencing a slowdown in business, which means future earnings may not be able to grow. Just as you can calculate a PE ratio, you can also calculate a price to free cash flow ratio. However, these ratios both share the same limitations. Also, check whether a company is growing its cash reserves or burning through its cash reserves. Finally, always put these figures into perspective. They never tell you the complete story. You will have to dig a bit deeper to find out how a company is actually performing. Cool. Now that you have learned about financial statements, financial ratios, and free cash flow, you are well on your way to becoming a true value investor. However, how can you protect yourself against companies who cook the books, meaning that they might be reporting high profits while they are actually not making any money at all? Enron is a classic example of this. In the next lesson, we explain how you can identify and avoid these so-called value traps.